In today's show, I am delighted to speak with Kevin Whelan. Kevin, you are an economist, author, the founder of Wealth Builders, and one of the UK's leading authorities on small self-administered scheme pensions. You are an articulate speaker on the subject of financial independence, and you have a credible track record in helping both business owners create streams of recurring income and also assisting employees to jump off the corporate treadmill. You are also very passionate about improving financial literacy for our children. Kevin, welcome to the show. It's such a pleasure to speak with you today.
Aggie, it's been a real pleasure to build up to this, and I'm very much looking forward to exchanging some well-defined, well-considered and well-thought-out words that can be actionable. And I'm hoping that some of the ideas we share can be a catalyst for one or two people to take some action to become financially independent, as opposed to the opposite, which is dependency on so many things that if we want to get into that, we can do that.
We certainly have a lot to talk about, and I liked what you said about how we were building up to this, because it took us a little while to actually have this conversation today, but I'm very grateful that we are here. We're going to discuss some of those things that you said earlier and hopefully become the catalyst for someone to take action towards their financial independence. I would like to start, before we go there, with a little brief introduction or journey from you. Specifically, what I would like to ask you is to share with us a key defining moment in your journey, perhaps regarding finances, which is the most relevance with the conversation.
Yeah, unquestionably, the most key defining moment of my entire life when it comes to the subject of wealth happened when my father died suddenly at the age of 46. He was an oil rig worker in Aberdeen, had a good business. We were doing well as a family. And unfortunately, he died. Now, tragedy is, I'm sure felt by many people. But from my perspective, as a young economist, I was around 25 at the time when he died. And I was just planning to get married and sort of made a mental decision based on mathematical analysis, which was, if I go when he goes, or if I go when he went, I don't think I can save enough money after tax to pay for the life and the family that, myself and my wife were planning to have. And so I made a sort of change. It took a while, but I felt the catalyst inside me, hence that word again. Something which stimulates someone to change a pattern, a course or behavior, and hopefully for the good. And that catalyst for me was, I need to change my paradigm. I need to look at things in a different way. And the way that I decided to look at things, the lens that I decided to frame everything through, was not to trade time for money, and to be completely focused on the ownership of assets or things that I could either own and control that would throw off income, which I now call recurring income, income which repeats and repeats and repeats, and that the ownership of that income would not be dependent on me, and it could pass on to my family or any other causes that we would want. And over the course of the years then, since that date, my skill, my ability to hone my thinking in this regard, and then to create materials, courses, a number of books on the subject, and build many, many relations, hundreds and hundreds of relationships now, where I think I've got almost like a CAT scan brain. So I suppose, you go to the hospital and you might need a CAT scan to get a really good cross-section of what's going on inside your body. And my brain allows me to be a CAT scan for somebody's finances. So within a very few minutes, within a very short period of time, I can diagnose the financial health of pretty much anyone. And I've put that skill to work, and now incorporated that skill into, as I said, books, courses, and engaged with a whole team now who replicate and teach the IP, the intellectual property that I've created over the years. And now we have a very successful business called Wealth Builders, which does what it says on the tin. It's all about helping people to become completely financially independent, not just for money's sake, but for the freedom that financial independence can bring, from where you want to work, who you want to work with. Do you want to work at all? You can live out your own passions and do things if you want to do them, when you want to do them, with who you want to do them. The whole principle is about choice. And I think over the years, being able to develop those choices for myself. And now I've spent as much time post becoming financially independent, teaching others how to do the same. And I'm really passionate about it. I get a real pleasure from doing it and helping people make distinctions of their own, even if it's just one distinction that makes a difference to their family. Because I think in the end, it all came from a death, which caused me to think about a legacy. And that legacy remains the most important thing to me. I've got 3 grown-up children now, Aggie. And, you know, I spend a lot of time with them, but I spend a lot of time now trying to help other parents with children of all ages from 8 to 28, how to become a fantastic money role model for their kids. And it, not just about the teaching and the sharing of education, because there's enough education in school, but not in this subject. I don't know about you, Aggie, but I missed that class.
Yeah, you know, me too.
It wasn't there, you know, even at university with a economics degree, it wasn't there. Finance was never there. So I think it's now my responsibility, and I take it seriously, to try and build materials to help parents do a better job. They want to. There's an intention. But in order to be a great teacher, you've got to know more. So it's not about teaching the kids so much as about really empowering the parents. So thanks for the question. And I hope I've given a broad enough answer to you to go off in a different direction and see where you want to take it next.
You have, and you actually covered the question that I was about to ask about your motivation behind, helping others achieve financial independence. There was one other thing that I wanted to ask you before we move on to more practical stuff, but I think it is essential. You talked about when you change your own paradigm, as you said, specifically it was not to trade your time for money and shift that paradigm. Do you think that this mindset shift, this changing of the paradigm is a fundamental for others that want to pursue or achieve financial independence?
Yes, I believe it's fundamental. I believe it's a fundamental principle. So one of the important distinctions I would make is I don't hold myself out to be a guru with ideas that you can apply and somehow there'll be a magic shortcut or a magic pill. No. What I prefer to do is say, here's a way of looking at things. Here's a principle that should be universal, whether you're listening to this in United Kingdom, the United States, wherever you might be listening, you can apply a principle and that principle will work. And that's what I like to share. So the principle then of trading time for money is understanding where income flows. So for the most part, we're taught or we copy, we have an imprint that says we should get good jobs, we should earn money, and from that money we earn, we should save money and plan for a retirement. That's sort of the paradigm. My argument is not that paradigm. It's to say, well, you could do that, but instead you could understand that you could own and control assets, things that you can own that will put money into your bank account while you sleep. You can enjoy fully doing it and building it, and you can share that knowledge with the next generation and dispense the wisdom to help them grow and accumulate that for generations yet to come. And it's a fundamentally different way of looking at things than the scarcity mindset of you work and you pay tax and then somehow you've just got to a body of money left over, which if we get into that dialogue, I think there's a fundamental flaw in the way there's been a transition for how people generate income when they leave it late. I think you can become financially independent in 5 years. 5 years of making good decisions as opposed to 30 to 35 years of making mediocre ones. And I think that's the key message that I'd like to get across. And I'd love to dive into what those assets are, because over the years, my own intellectual property on this, and I'm always up for the challenge, Aggie, if anybody else coming up with another, but I've determined there are 7 and only 7 assets that you can own to build wealth. Now, there's a whole myriad of opportunities underneath each of those 7. But once you can master the thought of, okay, if I can own the asset and the asset gives me income and that income doesn't depend on me being there, then you can create a level of independence, independent from the state of political farce that we're having right now, independent from what's happening with diseases or pandemics, independent of what's happening with the economy, what's happening to inflation. So the more you can understand, the more then you can apply the principle. And we'll definitely get into things of application as opposed to theoretical. So this is economics that can be applied, not economics that can just be understood as a mathematician or an economist might take from a university degree. So these are practical things. And if you can get it that there are only 7, then wealth building is scientific, because you can find and build that unique combination of your own 7. Doesn't have to be all 7, but if you know them all, then you can decide which combination works for you.
That's great, and we will talk about the 7 classes of assets. Before we go, and I very much like that you said that we won't stay on the theoretical level, but instead offer some practical elements in the conversation as well. And actually, I would like to go into these applications, really. As a preface, before we go there, I would say something that actually I read it in one of your websites. You were saying that there is a financial storm ahead, and we know that interest rates are rising. We recorded this conversation end of 2022. Energy costs have doubled. Inflation is spiraling. And during this period, we're going to discuss the topic of financial independence, which is on maybe the opposite side of it, and both for business owners and for ambitious employees. Before we start with this nitty-gritty, do you want to share any disclaimer for the conversation, or shall we just dive straight in? I do have many questions to ask you, but
I don't normally get worried by disclaimers, because I'm just giving principles that I believe somebody could absorb. There's going to be no attempt to give any advice. There's no attempt to give any guidance.
That's brilliant.
I think it's fair to say that anybody can listen to what they want to listen to, and then before they make any fundamental decisions around their money and their wealth, they should consult with someone that they believe has got the necessary qualifications so to do. And I'm not attempting to do that in our conversation today.
Thank you very much for sharing that. I would like to start then by addressing business owners, people who already are in a business, their business, but they don't necessarily have created this recurring income, as you say, or the passive income, as it's called. So I would like to address those people first, and if you could share with us some of the ways a business owner can take steps towards the financial independence. And now I will ask for more practical things rather than the mindset things that we briefly discussed earlier on.
Okay. I will make one distinction just because you raised it yourself. Recurring
Yes.
income and passive income are not the same, because I don't believe any income is fundamentally passive,
Okay.
because there's an element of management that's needed in every regard.
Of course.
So I believe if we're stewards of our wealth, stewards of our money, there needs to be stewardship, and that's not passive, that's active. Now, that being said, business owners are a wonderful category, and I love dealing with business owners, but they show and share so many frustrations, because often when someone is in business, there's sometimes a misunderstanding that the business itself is an asset. Well, an asset is something that works without you, and it puts money in your bank account while you're asleep. And for the most part, people in business are not doing that. They're simply performing a function, trading time for money, a service for money, a product for money, and that the revenue does not recur. So there are a number of elements in there. So for a start, I'd touch on those distinctions. So from my perspective, if I'm talking to a business owner, usually I'm saying, look, you can create recurring income inside of your business, recurring income outside of your business, or you can do both. Now, to create it inside the business, I'll just take a moment on that. And I believe there are three powerful ingredients that work together in order to make that happen. Firstly, and I call it my 3-pin plug, it's like, boom, it puts power into any business. The first one is to operate very clearly and define the value add you bring in a niche. In other words, to become outstanding at adding value to a group of people in a niche, or a group of business owners. But in the end, it's always people who receive value. Second is to understand that the income from the service or the product that you deliver can become more recurring than it can become linear. So you can auto ship something, you can auto provide something. To what extent do you have an automatic income coming from your business? For most people, it's zero. But you can look at that because there are a number of different ways that you can harness thoughts to generate recurring income in a business. And the third is to imagine the business needs to work without you. Not necessarily at the beginning, but certainly as you set it up, then at some point that you are no longer required. You don't need to show up for the money to continue to show up, which therefore means you've got a business that you can keep, you could pass on, you could sell to an acquirer, or you could sell to management or employees. You've got so many more choices of disposal of a business. And in the end, as Shakespeare, will say, all the world's a stage and the men and women are merely players, and we all have our entrances and our exits. Every business has an exit. My father, unfortunate exit. He died without putting things in place. We can't control those things, but you can stage manage exit left with the business if you can understand how you're orchestrating that. Now, if that's not your business and you want a lifestyle business that depends on you and you like that, nothing wrong with that. Absolutely nothing wrong with having a wonderful, balanced business that allows you to spend time with your family and do what you want to do. And I love that too. But then you have to create recurring income outside of the business, because if it always depends on you and you acknowledge that, then building the wealth in the 7 pillars, as I mentioned, is the next skill. So understanding, are you building it inside or outside? Now, it's easier to build outside because you can apply the straightforward principles. Working inside the business is much harder because many people have, I suppose, created a process in their business which is very difficult to change. Whereas it's very easy to say, well, look, if I'm making profit, I could take profit from the business and I could use that profit in a whole raft of different ways that will lead me to be growing my wealth, so that at some point, whether I keep the business, sell the business in whatever manner I wish, I built up and flexed the decision-making muscles about being an investor in things, in assets, and that if I get a big check, I know what to do with the money. And if I never get a big check, I'm financially independent anyway. So that's why I try and teach it that way. to allow people to become financially independent, either with or without their business. And the sad fact is, I did a speech on this recently to 2,000 business owners, and I talked about this. And one of the statistics that seems to grab their attention is the data for selling businesses is not well kept. However, there is one piece of data which is the capital gains tax relief that's available. What used to be called entrepreneurs relief is now called business asset disposal relief. But anyway, same thing. What it means is when you sell a business and you gain a capital gain, instead of paying corporation tax or capital gains tax in the normal way, you only pay tax of 10%. Now, those records of those claims are known. And of 5 million business owners in the UK, only 5,000 business owners a year sell for more than £1 million. In other words, life-changing money only happens in 0.1% of the business community. So the odds are not stacked in favor of businesses selling their business for a massive sum of money, which is why I think it's more important to be building wealth as you go, not hoping that one day, someday, your business will sell. Because so many businesses don't sell because the owner gets old, the owner gets ill, the owner gets divorced. A whole series of different things can intervene with the plans for a business owner to sell. And I believe it's better to be building wealth as you grow the business and as you keep the business so that you can do it either way. Either way, you're going to be financially free, whether you keep the business or whether you don't. Hope that helps.
It does, thank you. And I was actually curious with what you said about the businesses they sell. And without going into that topic too much, but I would like a brief comment. What is the difference, you believe, between those very few that sell, the 5,000 that you said, versus the others that never do? What's the one major difference between those two?
Well, it's the focus on the 3-pin plug, or they may not have thought about it that way, but the business can work without them. Okay. They've got a business that delivers on a recurring basis, and therefore it's very easy for an acquirer, because an acquirer at the end of the day, that's when you get the most money from the sale of a business, is from an acquirer. And an acquirer really wants one thing. They want predictable, dependable profit. Now, usually when somebody wants to sell a business, I've just moved house, Aggie, and when you move house, the value of the house you're selling, the value of your house you're buying. It's pretty straightforward. Yes, there might be some variety, but generally speaking, you know that. Does anybody know the value of their business? They really don't. For the most part, the business owner overvalues their business because they put in the blood, sweat, and the years. But the acquirer is not interested in that. The acquirer is interested in predictable profit, which is why, for the most part, when business owners even do sell, they sell with an earnout. They sell with a dependency for the numbers to work, because the acquirer won't buy into the truth until they've had it for a period of time. Mm-hmm. Whereas if your business works brilliantly in a niche, it works absolutely without you, and there's a proven recurring income coming in, it's easy. You don't need to be there because they can see it's working effortlessly without you being there in the first place. So if you put those 3 principles into play, you're much more likely to sell your business to the highest, most valuable outcome for you. And that's the answer to that question.
Thank you. And before we discuss those 7 pillars that you talked about, I would also like to ask a similar question that I did about business owners, but let's address also the employees that would like, to step out of this treadmill and do their own thing or their own business. Mm-hmm. You talk about making more on the side, but how much of what you said about the recurring income inside and outside applies to the employees? Obviously, because they obviously have, to some extent, a limit to what they can earn by exchanging their time for money as employees.
Yeah. Well, the principle of employeeship is trading time for money largely. There are other types of pay structure, but largely that. Mm-hmm. And therefore, you're always dependent on that. You can't pass on the job to the next generation. There isn't a legacy there. So it's really a mindset issue, starting there with understanding that if you're in a job, nothing wrong with being a job holder. You hold a job, you don't own the job, but you hold it temporarily. And the thing to understand is when you're trading time for money, there's always arbitrage happening. What I mean by that is if you know, for example, you've got savings and you know there's an institution like a building society or a bank, they're making money on, they give you a savings rate, but they lend money out at a different rate. So there's always a profit margin. So when you're tuned to that, you can look out for that and say, okay, well, I'm selling my services to my employer for X pounds per hour. And the easy way to do that is divide your salary by 2. So if your salary is 50,000, you're on 25 pounds an hour. If your salary is 100,000, you're on 50 pounds an hour. If your salary is $1 million, you're on 500 pounds an hour. It's very easy formula to work out. Now, once you've worked out that you're trading time for money at that equivalent rate per hour, then for the business to be profitable, it must be selling your services at higher than that. So it's then just understanding, well, what is the value that I'm bringing to make that more effective for the business that I'm working for? And is there a way that you could become an intrapreneur? So instead of checking out of the rat race, getting off the treadmill, and there's a risk attached to that, but there's a way to break the fall by doing things gradually. Mm-hmm. However, if you can approach the employer with a view to say, well, I know where the value is you're seeking to create as a firm, and here's a way I can provide even more value because you're watching it and paying attention to it, then you can negotiate with your employer. Instead of going on strike, you can negotiate in terms of where the value is being created. And I think that's a paradigm shift that many employees may not yet have, which is, in the end, they're a team player for the moment. And if you can be a team player and perform at your highest level until another team shows up that you can trade your time for money for a higher level, but you can invest the proceeds. So in the same way as a business owner can build their wealth as they grow their business, an employee can build their wealth as they grow their income. And many people are skilled at growing income, but they're less skilled at growing that independent flow of money from assets after the income has been paid. Usually because, well, as you mentioned, credit crunches, pandemics, spiraling inflation, interest rates, stock market volatility. There's a whole array of reasons that can cloud people's judgment. But again, once you come back to the principles of, well, what are the ways I can build wealth? What are the 7 individual assets that I can own? Then you can always do something to build one. And the mantra that we use within Wealth Builders and the people who engage with us to become financially independent is to never let 30 days go by without doing something positive towards building your wealth. And that could be learning something. It could be reading something. It could be just experiencing something. If there's anything can be done in a month period. And we try and do it that way because most employees think of themselves in a monthly cycle. They get paid a salary and that salary normally arrives monthly. So that's the way we approach it, is to say you can always do something. Let's find the one thing that you can do that will make a difference. And that's all about making those distinctions that apply to their circumstances, their family situation, the time they have available. And of course, we've had, with the pandemic, a complete change in the way people work. Historically, it was all about going to an office. Yeah. Now it's increasingly about going to and working from home. Mm-hmm. And that combination for many has given them a newfound freedom. So instead of the unpaid commute, they can take that time and apply some of the lessons that we would share and say, well, put this to work. And that's why I love things like podcasts, Aggie, because they allow people to leverage their time, whether they're commuting, whether they're exercising, walking the dog, whatever they want to do. So it's a great inspiration to be able to do that rather than just simply be entertained.
100% agree with you, and I will digress just for a moment, because I have often people asking me, why is a podcast better than a YouTube channel? And I think you gave in your last sentence very good reasons what the big advantage of them is. So anyway, I'm not going to stay there. I just wanted to make a comment, because I've had this conversation often with people. Let me ask you then about these 7 pillars, these assets that can create an independent flow of money for you. And by the way, I will also say, now that I remember, thank you for your comment earlier about the term passive. I never liked that phrase passive, but it is used, I think, sometimes in a misleading way to imply that it is, as you said. So I liked very much your explanation about being in stewardship of the money. So thank you for that. So let's discuss briefly those 7 pillars, those assets, and time and whatever conversation takes us, we could go a bit deeper in maybe one of them. But let's give a brief overview.
Yeah, let's do that. So 95% of the population in the UK and the US will never become financially independent. Mm-hmm. And that's a staggering statistic. And one of the main reasons is the simplicity of the approach that is taken. And so if you can imagine, and perhaps because this isn't a YouTube channel, so you can't see the 7 pillars and how they're represented, but if you just imagine a square or a circle, and on the right-hand side, what most people do, and on the left-hand side, the ways that you can massively turbocharge your wealth building activities. So for the most part, like 3 legs of a spider, most people have 3 things in their life. They have a home that they live in. They have some form of pension or retirement planning, and they have some form of money in cash or investments. And those would be the first 3 pillars. So pillar number 1, I call it home capacity. There's a capacity in everyone's home to generate income. Whether we choose to exercise or not is just a matter of our own personal decision about how we do that. But if, for the most part, people live in houses, they don't generate an income from them. But increasingly, though, that's changing. Mm-hmm. We're seeing a change towards Airbnb. We're seeing people with rent-to-room schemes with $7,500 a year you can earn tax-free. We've seen that with refugees. We've seen people tapping into building extensions on their home or building capacity around the space they have to turn that into a source of money. And increasingly now, we're seeing that. So you can turn your home into a source of revenue. And ultimately, people do anyway, because if you get the maths wrong and you determine that your financial independence is just not coming and you realize it too late, what do most people do? They downsize. So they do it then. And I'm just suggesting that, well, why don't you imagine you could do that now? And many people tap into the equity of their property through mortgaging, buying other assets, and then making money from that to pay themselves back. So they're just moving money internally with newfound knowledge and newfound application to be able to just borrow from themselves. So they're using their own internal arbitrage as opposed to allowing the banks or the institutions to do it on their behalf and remove them from the profit. So home capacity is pillar number 1. Pillar number 2 is the most underutilized, undervalued, poorly performing asset of all, and it's people's retirement plans. And my blood boils at the poor value that is delivered by most institutional pensions, because in the end, people are buying into a long-term accumulation plan to buy money in the stock market, often at a retail price where the arbitrage is taken by the financial institutions. It's a product at the end of the day, and that product has to be sold for a profit. And there's a way to change that. But let's say most people don't. And institutionally, then they're depending on some long-term future value when they reach a retirement date. Now, let's say someone reaches retirement with a reasonable pot of money. Let's say it's £500,000. That sounds reasonable. They get £500,000 in their pot. And now they've got to turn that income from an asset that's fundamentally volatile and uncertain, and they need to create certainty of income for the rest of their life. That's an impossible task. When you've got the uncertainty of inflation, the uncertainty of the stock market, there's no compounding magically happening inside the stock market. And then you're dependent and you go into scarcity mindset for the rest of your life because you're hoping you can cling on to enough money to make that journey so that you've got some money left at the end of your life, as opposed to income that would be automatically accruing and paying to you that's dependable, and not volatile. If you imagine you and I are both old enough to have seen a few economic downturns. Now, if you imagine somebody hits 65 and then all of a sudden the stock market crashes like, say, 2008, and they lose 50% of their money, how do you recover from that? Short answer, you don't. And you live a life of compromise for the rest of your life. And I'm troubled by the lack of attention and the lack of transparency that the pension industry shows. And as a result, most people do a very, very poor job. Because 500,000, if you were to talk to an advisor about that, they would say you can probably draw 4% out of that. Mm-hmm. So what's known as drawdown, safe drawdown. It's not safe at all, but let's imagine, even if it were, 4%, that's 20,000. Well, if you want a decent income, and I mean, financial independence is life without compromise. It's doing things that you want to do when you want to do them on your terms. And for most people, that means increasing the income they need because they want to enjoy life, not compromise and skimp and scrape for the remainder of their life and then show that lesson to the next generation. Mm-hmm. It's a tragic, tragic waste of resources. And I'm passionate about changing that in two regards. One is to help people understand they can actually control the direction of their investment. And that's normally through recognizing that they can take control. But most people fear that control is because they don't know how. So we teach how you can take control. And number two is dramatically cut the fees, because the vast majority of people in the UK, certainly, and in America, are paying around 2% of their overall value in fees and charges. There's about 7 different layers of fees, and I won't go into that today, but I've definitely done that on speeches and podcasts and other things. And those fees mean that if you take that 4% drawdown, and if the stock market was, say, growing at 6, and you're paying 2 for your money to be managed, when the management is really quite simple, that's a third of your money being paid to a third party. And it's not just that consequence, is that money's paid before you get paid. Before any growth, before. So they take their money no matter what, whether the market goes up or down, they get paid. And I think that's wrong. And that's why I like to suggest to people ways that they can dramatically cut the cost of having their money managed. But they have to have stewardship. They have to be willing to learn what needs to be done. And it is not complex, Aggie. On a different day, I could share with you what is done is not complicated at all. It's actually so simple. But what's better is to learn other ways to grow your money rather than rely on the stock market. And then before I get too much on my soapbox, pillar number 3, which is investing outside of the pension in markets, is the same asset. It's the same problem. So there's an over-concentration of people with property that doesn't work, stock markets that don't work, fees that are overcharged, and an over-concentration in the stock market in both retirement planning and investing, because ISAs are in the same place as the pensions. And there's no way to prevent that unless you're willing to invest some time in your own education. And I think so few people are willing to do that. But fortunately, we find enough, and we act as a catalyst, and then we set about providing the right education and support and community and connection to help people discover that it is possible to move that paradigm, to cross the Rubicon from pillars 1, 2, 3 to 4, 5, 6, 7, And on that side, we have number 4, which is building a portfolio of property. So not the property you live in, but a portfolio of property that you can rent out and generate an income from a third party, whether that's to a institution, whether that's to a company, whether that's to an individual, whether that's to a family. There's dozens and dozens of different ways to serve a tenant type to get a recurring, not passive, but recurring income flowing into your life. Number 5 is a business that works without you. So a recurring income business along the lines that I described earlier in our conversation. Pillar 6 is intellectual property. How do you make money? How do you generate a recurring income from what you know, from what you do, from what you're outstanding at? And how can you turn that into a rich source of revenue for the future? And then number 7, really important, joint ventures and collaborations. How do you bring your knowledge, skill, time, combine it with other people's knowledge, skill, time, and create more value where you share not just in the values with others, but you share in the value. So you don't have to be simply a product buyer. You can become a collaborator. So you could become a bank. You could lend your own money. You could invest with other people. There's just a myriad, a whole kaleidoscope of different ways that people find in our community to work together to create more value than the value they can create on their own, because they're combining their mind, the distinctions they make, and the principles that we share. And when you do all that, then you can achieve significant returns without the risk, without the fees, and without that overdependence on the stock market. So that's the nutshell whistle-stop tour of the 7 pillars of wealth. And I'm always fascinated if somebody can help me come up with number 8, because, 8's a great symbol. It looks like infinity, but I haven't found it yet. And I've been searching for 30 years and I haven't found it. I've got some ideas where it might come from in the future, and it will probably be our own intellectual property and our own ability to sell our own data, because we're in a data-driven society. And at the moment, people take our data from us and use it. I think in the future, we'll be able to sell it, and we'll own our own right. And I will sell you the rights to my data so you know what I'm buying and who I'm buying it with. But you pay me royalty for it, rather than you just collect the data and then you use it for your own devices. I'm saying you, but I don't mean you personally.
Sure, that might happen in the future. At the moment, it's theoretical. But I was smiling throughout your wonderful explanation of these 7 assets, especially when you talked about the number 6 and 7, the intellectual property and the joint ventures and collaborations. I thought that we could certainly have a whole 1-hour conversation on the podcast about only those 2, because I feel the way that you presented those 7, that some of them, at least in my sphere of knowledge, and the other ones are more discussed than these 2 last ones. So I think there is quite a lot there. So maybe we can in the future, go deeper on those. Yeah. I know we have limited time together, and there is certainly a topic that I did want to have a comment from you as well, and that was improving financial literacy for our children. And I know you're very passionate about that. So again, I would like to ask in a brief way, what, even though I think the importance of it is beyond obvious, but if you could share just something for the importance of it. But even more than that, how can a parent take some actionable steps towards that direction, towards educating or giving to their child more financial literacy?
That's a great question. I think the best way to frame this is, if you've ever been on an aeroplane, when they're giving you the safety demonstration and briefing, they say, when the oxygen mask falls, please secure your own mask before securing that of your child. And that's a perfect illustration of the mindset, that take care of your own stewardship And how we do that is encourage anyone who works within the Wealth Builders community to create a family wealth business. In other words, we give it a name, we give it a logo, we give it an emblem, we give it values, so that people can begin to see that they are the beginning pioneers of a new form of paradigm, a new form of wealth creation that they start. And once they start it, then by osmosis, whoever's around them is going to notice that. And then once they do that, it's then what are the lessons, the actionable things, because you can't teach somebody else if you don't know enough. And part of the reason why I think, look, if you were to say, well, why don't they teach it at schools? Why don't they teach it at universities? Because the very people, with no disrespect intended, who work in our schools and work in our educational establishments are not financially independent. Mm-hmm. They don't have the skills for that. They're trading time for money, yes, in a very meaningful way, but they don't have the skills to be able to teach. So it's not taught, and it's not going to get on the agenda anytime soon. Mm-hmm. So the only way to bring it on the agenda is for the parents to want to bring about the change, and then for the parents to change themselves. Mm-hmm. And once they do that, then they can bring a milder form of education, more participation, more involvement. We're creating a community called Wealth Builders for Families, case studies and examples of best practice that you wouldn't even dream people doing with their kids. Mm. But once you get somebody else's distinction, a bit like the collaborations and the joint ventures, you can see, wow, that's interesting. That would really suit my child number one or my child number two, because all of our children are different. I've got 3 kids. I paid for them all to go to private school and university education, but they're all completely different. And I love that. Mm-hmm. And no single way would have worked. And each one of them is pursuing a different career and a different path. And yes, I've tried to influence them, but in the end, that influence, it's their call whether they take it. But they're absorbing it and they're speaking some of the language, and sometimes the joke, because they know dad's on his soapbox again. But I can live with that because they understand the integrity and the intention through which I do things. Mm-hmm. So even if they're having a joke at my expense, they've got the lesson. Yeah. And they're open and willing to talk about things that are happening in their grown-up life, when they get a company car, or what does the tax return look like? Just some basic things that they can be more involved and feel that we can be trusted to help them overcome that. Because in the absence of that, they're going to be educated in the wrong direction by the very institutions, the banks and the financial institutions, which will grab them at the earliest opportunity. And that grabbing takes place normally when they get to about 18 and get to university, and their details are paramount to every institution around, because they know they're going to be the earners of the future and they want to put a siphon in their life. And I'm trying to encourage the opposite of that, for them to build wealth building siphons of their own, where automatic income is flowing into their life. Even if they temporarily choose the job route, I still want them to understand, well, you can have a job and build pillars, or you could learn enough in a job, learn enough in that environment, and then when you're ready, become a business owner or become an entrepreneur, if that's a path that best suits who you are. And I think that will definitely apply to 1 or 2 of my sons and daughters, but it won't be all of them. I'm certain not all of them will be entrepreneurs. But the value of them all knowing these things is not just in how it impacts on their life, but as we grow and build and protect our wealth, and we create a family charter with rules that they can then embrace, amend, just like all charters have done in history. The next generation amends that and takes it to another level. And as long as the values of growing the wealth with integrity, sharing, participating, as long as those things are there, then that money that I've worked hard to build, which is recurring, they will nurture and they will keep it and they will expand it for generations way beyond me. So that in 150 years' time, long after I've gone, some will be toasting the old bugger, that would be me. Hopefully I'm old, right? And saying, congrats to Dad, with a glass of this or a glass of that, just to say, yeah, we did a good job together. And I love that principle, and that's the principle that we share and teach.
Thank you. Kevin, I want to thank you for a truly fascinating discussion. I enjoyed very much. I have a couple of quick fire questions to ask you as wrapping it up. Before I do that, please share with the listener what is the best place for someone to reach you and find out more about what you do.
Sure. Well, thank you for that. Wealthbuilders.co.uk is the website. Mm-hmm. If there's any information you think would be valuable, I can give every one of your listeners a free copy of the book, The 7 Pillars of Wealth. I'm more than happy to do that. If you care to give me talk about a link, and we can put a link in the show notes. They can download that, mm-hmm. So that's free and complimentary. Or just reach out on LinkedIn, Facebook, anywhere you find old, grey, wizened people like me, and say hi and just listen to the podcast with Aggie, and then that's just good. I would love one person to be an influence enough to be a catalyst for them so that, they go on a different journey to become financially independent as opposed to being dependent.
Amen. And I will also share that about this one person, because that one person has the potential to create a ripple effect beyond any other comprehension and that's a completely different topic altogether. But thank you for bringing that up as well. It is my wish also, always, with the podcast, So, Kevin, a couple of quick fire questions. I always ask them, my guests. And the first one is, what does personal development mean to you?
It means being humble, to accept that you don't know everything yet.
Mm-hmm. I like it. And if you could go back in time, theoretically speaking, and meet your 18-year-old self, what's one piece of advice you would give him?
Well, I think the same. Don't be so arrogant to assume you know everything. You're 18, man. Sort yourself out. Take lessons from people who are older and wiser than you. I would have been financially independent much younger had I not suffered my own pill of slight arrogance, thinking I knew more than I did. Yeah, I would have taken that pill a lot sooner, Aggie. I definitely would have done that.
That's great. Kevin, thank you so much for this conversation today. I really appreciate it. All the very best with your mission to empower others to become financially independent. Any last parting words?
No, just thank you for the opportunity to listen and repeating that point that if this has been a catalyst for you, let Aggie know, because we'll watch those ripple effects. And if you're remotely interested in being a wonderful parent, to be a fantastic money role model for your kids, get in touch, because that will be coming early in 2023.
Thank you. Thank you very